Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with your portfolio construction and asset allocation. Now, we've got less than 2 months to go from the US presidential and congressional elections. Many investors in the region are clearly focusing on the potential outcome and what this would mean for them. So I'm delighted to be joined by Stephanie Aliaga, our global market strategist based in New York, to share with us her view on the election so far, as well as the policies and market implications from the two presidential candidates.
Hi, Tai. Thanks for having me.
Hi, Stephanie. Thanks for joining us. Let's start with taxes and government spending, since this is a topic that's front and center of pretty much every election. What are the policy proposed by Paris and Trump? Are these likely to go through if we have a divided government, and what this means for the US fiscal position and corporate earnings in the long run?
Great place to start. And I think for starters, let's just consider the economic context for the United States right now. There's no pandemic, there's no major recession, there's no need for any major fiscal spending, bill, or upheaval. But there is this issue with the Tax Cut and Jobs Act, which was a signature piece of Trump's administration, that is due to expire at the end of 2025. Those expiring provisions require legislative action, or else they just sunset. And so all of those tax cuts that were included in the 2017 Act revert to their previous levels. And that would mean a lot of Americans see their taxes increase. So really, whoever is the next president is going to have to figure out what to do about this before that expiration date. And that means in a year, in an environment where there's not much appetite or need for fiscal reform, there is this issue of tax policy and what to do with these provisions. So in a presidential race that has been actually quite sparse and many detailed policy agendas, the taxes front has been one where both candidates have been more vocal on. So what have we heard from the two sides? Well, Trump has been, quite vocal in his support for making many of those expiring provisions permanent. So all of those personal income tax cuts that were delivered would be renewed. He's also talked about trying to do further tax cuts. So he's mentioned cutting the corporate tax rate from 21% to 15% or maybe 20%. We take that with a grain of salt, just given all of the focus around the deficit lately on Washington and in the markets. But maybe he does try to enact some of that. And he's also mentioned other things like eliminating taxes on tips and Social Security benefits and renewing some of the business tax provisions that had actually already expired from the TCJA. But Trump, very much in favor. We're renewing the TCJA in whole, and then maybe we actually deliver some new tax cuts. On the other side of the aisle, what has Harris been saying? Well, she is in favor of renewing most of these expiring provisions, particularly for those lower middle income households or really anyone making below $400,000 a year in household income. That has been, I think, a key thing here is we're not looking at tax hikes by any major magnitude from either election outcome. Even Harris is looking at extending most of these, and she actually has her own plan of tax incentives in the form of a renewed child tax credit, a new $6,000 credit for newborns. She's also mentioned things like housing tax incentives, the extension of a health insurance premium tax credit, also exempting tips from the income tax, which we really don't think is realistic from either candidate, and other things like tax deductions for startup businesses. Should also be some offsets. Trump has said that his ambitious tariffs would help offset some of this tax reduction or tax receipt reduction that he would see under an extension. You've also had, obviously Harris has talked about increasing the corporate tax rate. And so maybe, it's somewhere around this number, but I think by and large, we're just going to look at tax deficits being a little bit more elevated, and that likely just adds further, I think, evidence towards interest rates also being a little bit more elevated over the medium to long term here.
Now, one area that many APAC investors are worried about is obviously on trade policy. Now, former President Trump proposed a 60% tariff on imports from China and also a 10% tax on all imports around the world. Obviously, this has caught a lot of attention. What's Vice President Harris's stance on trade, and how could this change the global supply chain, again, in the longer future?
Yes, the other big issue on really the debate floor of this presidential race is trade. But interestingly, there is a lot more shared common ground on this issue than you might expect. For instance, under the Biden administration, you've had most of Trump's tariffs have actually remained in place. More tariff receipts have been collected under Biden than they were under Trump. And Biden has enacted new tariffs, particularly targeted ones on steel and aluminum from China during his administration. So some of this, I guess, sentiment around being tough on China, around being protectionist on the margin, and particularly focusing on protecting very sensitive sectors of the U.S. economy, things like, our electric vehicle production and chip production, that is going to continue to be a focus really in either election outcome for the next 4 years. But the two candidates do vary in their approaches. And, Trump has been very vocal about some really ambitious goals on the tariff front. He's proposed exactly to what you mentioned, the 60% tariff on imports from China and 10% on all imports. What I will say is this is an issue where, unlike taxes, the executive branch, the president in the United States, has a lot of authority just because of, historically what the law has said in the United States. It's given the president a lot of authority in this regard. So the markets are going to pay very close attention to what ultimately, if Trump is the next president, how focused he is on this issue. But I think by and large, what I'd say the outcomes is just under a Trump administration, you're going to see a harder line on more protectionist trade policies. And under a Harris administration, you're probably going to see a bit more of a focus on, maintaining alliances on the foreign policy field, but then focusing some of these more protectionist policies really on economically sensitive sectors and protecting U.S. intellectual property, particularly in regards to the AI arms race. Now, I think a Trump president would also care a lot about that too, but you're just going to see maybe a broader brushstroke from Trump than a Harris presidency. And to your second question on how would this change the global supply chain, this is actually the interesting trend here. Supply chain reorganization and friendshoring and, deglobalization, if some are calling it, this has been a new secular trend. It may have started in the early part of 2018 when that trade war really began between the U.S. and China, but it has continued. And, we have a slide in our Guide to Investing in Asia that shows U.S. imports by location. And you can see that imports from China peaked in January 2018. They've been steadily declining. Meanwhile, the rest of the world has been lining up to eat China's lunch, right? This has been a boon for industries in Mexico and Brazil and other East Asian economies, in some, parts of Europe and Canada. So, these trends and themes of friendshoring, of, supply chain reorganization, we think this is likely going to continue really regardless of the U.S. election, and it is much more reflective of just this new world of heightened geopolitical tensions that we're living in today.
On immigration, one key factor driving U.S. long-term economic growth is the plentiful supply of labor via immigration. Yet, like in many countries around the world, immigration is a contentious issue. What are the two candidates' position on this, and how will that impact on the U.S. economy and also on the markets?
You're absolutely right. Immigration has been one of the most contentious and politically divisive topics on the campaign trail this year. And the United States has experienced this surge in immigration in recent years, something that we hadn't seen for some time. Trump had enacted a lot of restrictions on the flow of immigration, and immigration had been slowing for quite some time until really like 2022. And now there's millions of more people in the United States today. We don't have an accurate count. It takes a lot of estimation, but the CBO and Brookings say that amounts to maybe like 5 or 6 million more workers in the economy from immigration. And the importance of that labor is it came at a time when the U.S. economy was actually really strapped for workers. We came out of this pandemic and this surge in demand rapidly outpaced the recovery in labor supply. And a lot of the pent-up demand and the unfilled job vacancies in the U.S. economy were really on the low-wage front. So service workers, healthcare workers, like construction workers, etc. And many of those sectors have now been able to fill those job openings with migrant labor, it seems. And I think that's kind of what the signals in the data seem to show us. And that is a huge benefit for economic growth over the medium to long term. I mean, this is an economy similar to many developed market economies, as you're familiar, that has an aging demographic distribution, right? We have aging baby boomers, and we're not churning out as many babies as we once were. And that's a problem, particularly when thinking about, what U.S. economic growth is going to look like 5-10 years into the future. So this surge in immigration has kind of redone some of the math when we even put our economic projections, and we've gotten a bit more optimistic because of this source of new labor supply growth. But that could be constrained or even reversed in this next administration. Trump has been very vocal in promising a crackdown on migration with much stricter immigration measures in an effort to deport asylum seekers and all of these new arrivals to other countries. Now, Harris has also been supportive of stricter deterrence measures. I think that's quite important here. Both sides are in favor of, getting control over the border. It's just a matter of what do we do with these new arrivals? Do we build pathways for them to achieve legal status so they can get further integrated into the U.S. economy? Or do we make that very difficult and we kind of try to reverse some of these immigration flows that we've seen? So all of that will kind of remain to be seen. I think our base case is we're going to see immigration moderate, but it's going to moderate gradually. Like, it's still quite elevated this year. And I think over the next 2 years, it's going to come down to more normal levels. But the economy should still be impacted over the next many years as those recent arrivals are integrated into the U.S. economy.
Now, much of the media attention has been focusing on the presidential race. What is the importance of the congressional race? Could we see a divided government, and what does that mean to some of the policy pledges that we've discussed above?
This is such a key question, and I think it really helps me make one of the key points for investors when looking at U.S. elections. It is really hard to, one, delineate campaign rhetoric, debate stage performance, a lot of these policy proposals that are championed on the campaign trail to what is ultimately passed in Washington once they're in office. Because so much of that depends on whether that president has influence in Congress, whether they have control over either or both parties of Congress. So what does that look like for this year? Well, in Congress, you have two houses. You have the Senate and the House of the Representatives. The Senate is much smaller, and only a third of seats are up for re-election every election year, which is every 2 years. This year, there are 34 seats up for re-election. 23 of those are held by Democrats. So just by the numbers, you have Democrats being much more on the defensive this election cycle relative to the Republicans. Now, the House of Representatives is much larger, and every seat is up for re-election every 2 years. So that the power of the House can swing a bit more depending on overall voter turnout and voter enthusiasm. But our base case and what a lot of these very tight presidential races have ultimately resulted in is divided government. Now, when Biden was first elected, the Democrats did get control, but very, very slim control over Congress. And even with that slim control, they had a really tough time getting a lot of the major things that they wanted done passed. So divided government is probably to be expected. And it's also where the United States spends 61% of its time in. Things are a lot harder to get done. There's political gridlock. But what does that mean for the markets? Really, it just means that we spend more of our time or less of our time talking about politics in Washington, more of our time talking about everything else, right? Interest rates, the macro earnings, everything else that we typically fill our investment conversations on. And I think, an interesting stat is like under divided government, the economy has grown on average 2.7%. Like that's near our, trend GDP growth rate in the United States. And the S&P has returned 8.3% annually. Whether it's red, whether it's blue, or whether you have a divided government in the United States, it tends to not be a huge or a very reliable indicator of economic performance or market performance.
Now, finally, if we take a step back, how should investors incorporate all these political developments into their portfolio construction?
Great question. And that's the key question on the top of many investors' minds this year is what are the market implications from the binary nature of this presidential election cycle in the United States? And I've mentioned, a few times in this conversation that it's really hard to decipher, what is said on the campaign trail to what can ultimately get passed in Congress. But it's also even harder to then ascribe market implications or investment signals from policy action. And, my favorite example to tell on this is really what happened with renewable energy stocks versus traditional oil and gas stocks under the Trump versus the Biden administration. Because, you might expect that under Trump, where you had a much friendlier president towards U.S. oil and gas production, fossil fuels, he wanted to galvanize U.S. production, that traditional energy stocks would fare a lot better under that administration. Meanwhile, under Biden, right, much more ambitious towards a lot of the clean energy goals for the United States. There you actually had legislation, right, a historic $369 billion towards renewable energy investment and incentives for consumption with the Inflation Reduction Act. But what you saw in the actual performance of those stocks or those, or indices that track those names is the opposite of what you might expect. Under Trump, you had the renewable energy index up nearly 300% under his administration. Whereas the, S&P 500 energy index, your traditional energy, was down 40%. And then if you look at Biden, in his administration, you've actually had renewable energy stocks down 54% so far, and traditional energy up more than 200%. If you would have bought traditional oil and gas and then sold it under, or under Trump and then sold it under Biden, right? You would have been on the opposite side of the trade under both of these cases. And that is because what ultimately drives markets, policy is one factor in the bucket, but there are so many other ones, and the others tend to be much more powerful too. I mean, if you just think about that renewable energy performance under the Trump administration, the Trump administration happened to be coincide at a time of quite low interest rates for the U.S. economy, particularly in that pandemic realm, right? Low interest rates, the cost of capital, hugely important for a lot of these clean energy companies. That has been the opposite case under Biden, just because of the economic context. It's warranted, it's required much higher interest rates. And then meanwhile, in the macro, you've had this global pandemic recovery that has led to much stronger demand for all forms of energy, but particularly traditional energy, because you've also had supply constraints. You had Russia, Ukraine, you had OPEC supply cuts. All of that has meant that it's been a much more profitable environment for these traditional oil and gas producers. So what ultimately explained stock price performance in this case had so much more to do with all of these other factors: interest rates, economic growth, the broader global expansion, much less to do with whoever was president at the time or really whatever they did. And so this year, I think it is just so important for investors to keep this in mind. Elections, they take up a lot of airtime in the media and many of our day-to-day conversations. But when it comes to investing and positioning portfolios, it is much more often noise and distraction than true investment signals. And investors would be, very wise to just kind of Take a lot of this investment chatter as noise and focus on the real questions at hand when it comes to your portfolio allocation and whether your investments are balanced to achieve your own long-term goals.
Stephanie, thanks for joining us today, and thank you, listeners, for tuning in to this podcast. If you have any additional questions on the elections or other investment-related issues, feel free to reach out to your JP Morgan Asset Management client advisors. Please also subscribe and share with your friends and colleagues if you find this podcast helpful. I'm Tai Hui. I'll see you next time to discuss what's on the investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.